You're building a $100 a week dividend machine, and SCHD is at the center of your plan. But here's the real question. Is SCHD still the ultimate dividend ETF in 2025, or has the game changed? With rising interest rates, shifts in sector performance, and competition from newer funds, the landscape is evolving fast. SCHD, once a fan favorite among dividend investors for its rock-solid yield, low expense ratio, and elite quality holdings, is now facing growing skepticism. Investors are asking, should I double down, diversify, or ditch it altogether? That's exactly what we're about to unpack. Because if you're committing to building long-term income and financial independence, every dollar and every decision matters. Whether you're starting fresh or already stacking dividends weekly, what you do next could define your next decade of passive income. One of the biggest mistakes people make when chasing dividends is getting seduced by yield without understanding the foundation of the ETF itself. Just because an ETF pays 4% or even 5% doesn't mean it's safe, sustainable, or growing. That's where SCHD originally stood out. It wasn't just about yield, it was about quality. Every holding had to meet strict profitability, dividend consistency, and financial health requirements. But here's the catch. Past performance doesn't guarantee future results. And with SCHD rebalancing annually, what's inside the ETF in 2025 isn't the same as it was even a year or two ago. That's where many investors go wrong. They assume they're investing in the same ETF year after year. But under the hood, the game changes. Let's be real. Another huge blind spot is cost. SCHD has an ultra-low expense ratio of just 0.06%, and that's been a major part of its appeal. Compare that to actively managed funds charging 0.5% or more. And it's easy to see why SCHD has gained such popularity. But in 2025, low-cost ETFs are the norm, not the exception. So while SCHD remains competitive, the advantage isn't as unique as it once was. Investors need to dig deeper, look beyond the headline yield and expense ratio, and analyze the underlying holdings, sector exposure, and dividend sustainability. If your goal is to build a $100 per week dividend machine with SCHD, that means aiming for $5,200 annually in passive income. At a 3.5% yield, which is SCHD's average in 2025, that means you need around $148,500 invested. Sounds like a lot. It is. But here's the power move. Reverse engineer that goal with weekly contributions. Start with $100 a week. At a modest 7% annual return, including dividends and compounding, you'd reach that target in roughly 16 to 17 years. But here's the twist. Reinvesting dividends accelerates the curve, and in some cases, significantly cuts down your timeline. That's why understanding compounding inside SCHD is key. It's not just about the yield. It's about letting your income generate more income. But is SCHD your best option in 2025? That's where the comparisons get interesting. Take a look at VAG, Vanguard Dividend Appreciation ETF, and DGRO, iShares Core Dividend Growth ETF. Both focus on growing dividends, but they follow different strategies. VIG excludes high yielders, focusing instead on consistent growth. Think companies like Microsoft or Johnson & Johnson. DGRO strikes a middle ground with a broader basket, capturing both yield and growth. SCHD, in contrast, prioritizes high-quality companies with a solid history of dividend payments, but doesn't necessarily require growth. This creates a unique balance of income and quality, but also exposes it to shifts in market dynamics, like sector underperformance. For example, in 2024, SCHD underperformed the S&P 500 due in part to its heavy weight in underperforming sectors like consumer staples and industrials. That's why understanding sector allocation is crucial. SCHD has traditionally leaned on sectors like financials, healthcare, and industrials. In a high-interest rate environment, some of these sectors shine, especially financials. But when rate cuts or economic slowdowns hit, they can drag on total returns. This is where diversification comes in. If you're all in on SCHD, you may be missing out on tech-driven growth or international exposure. A smart investor might use SCHD as a core holding, while complementing it with growth ETFs like VGT, Vanguard Information Technology ETF, or even global dividend plays like VYMI, Vanguard International High Dividend Yield. This approach maintains income stability while adding growth and diversification. The question then becomes, can SCHD alone carry your $100 per week dividend goal? Or should it be one piece of a broader strategy? Let's dig into the mechanics. SCHD pays quarterly, which means your income stream arrives 4 times a year. That can be a challenge if you're aiming for weekly income, unless you use a cash buffer strategy where dividend payouts accumulate and are dripped into your weekly cash flow. Alternatively, some investors build a dividend ladder using multiple ETFs with staggered payment schedules. Pairing SCHD with JP Morgan Equity Premium Income ETF, which pays monthly and uses a covered call strategy, can smooth income. JP comes with a higher expense ratio around 0.35%, but its monthly cash flow and 7-10% yield as of early 2025 make it attractive for income chasers. The trade-off? Less capital appreciation and potential risk in down markets. That's why you can't just set it and forget it. Even with an ETF, due diligence matters. Watch for changes in sector allocation, turnover in top holdings, and shifts in the index SCHD tracks, the Dow Jones U.S. Dividend 100 Index. Now, let's run through a quick reference breakdown to clarify how SCHD stacks up against similar ETFs. Imagine a table with SCHD, VIG, DGRO, JEPI, and VYMI. SCHD has an expense ratio of 0.06% and yields around 3.5%. Tracking the Dow Jones U.S. Dividend 100 Index. VG has a 0.06% expense ratio as well, but a lower yield around 2.1% and tracks the NASDAQ U.S. Dividend Achievers Select Index. DGRO comes in at 0.08% with a 2.4% yield, following a custom Morningstar index. JEPI, on the other hand, charges 0.35%, yields 7 to 10%, and follows an equity premium income strategy. Finally, VYMI carries a 0.22% fee, with a 4.5% yield and global exposure via the FTSE All-World ex-US High Dividend Yield Index. Each one serves a different purpose. SCHD stands strong for US-only, quality-focused dividends. JEPI delivers higher cash flow, but with a different risk profile. VIG and DGRO favor dividend growth, while VYMI provides international diversity. So what's the bottom line? If you're aiming to build a passive income machine, SCHD remains a powerful tool, but not necessarily the only one you should rely on. In 2025, it's still among the most efficient, consistent, and low-cost options out there, but it's not immune to market shifts. The key is strategy. Know your yield. Track your timeline. Reinvest. And most importantly, understand the tool you're using. Because if you're serious about financial freedom and making that $100 per week in dividends a reality, it's not just about picking an ETF, it's about building a system that works for you, no matter what the market throws your way. Dividend investing in 2025 is no longer a passive endeavor, it's an ongoing, dynamic process that demands strategic foresight, emotional resilience, and continuous learning. With tools like SCHD at the core and complementary ETFs enhancing stability and cash flow, investors can build a personalized, adaptable portfolio designed for long-term financial independence. The path is not linear, and the journey doesn't end. But with discipline, curiosity, and a proactive mindset, Investors are empowered to shape their own financial future amidst an ever-changing market landscape.